Sorry, I'm a little bit late. My colleague says I should say that I've had technical problems. I haven't. I've just been a bit tied up with other bits and bobs and didn't set an alarm to remind me. So I do apologise. Basically, what we do at the start of every month is a long-term outlook on currency pairs. We'll start with the dollar index, and then break them down through correlation, through chart formations, through some of our bespoke grey box system, and then we look at medium-term forecasts. Now, obviously, the main focus of late has been the US dollar, so that's where we're going to start, and then we'll break down through other currency pairs. One thing I should say is that there's quite high volatility at the moment in intraday trading. We will notice that when we go to the major currency pairs, that you'll be able to see that basically the big pictures, and by that I mean the sort of weekly time frames, daily time frames, have been dominating the price action. Intraday has been very choppy. I was talking to somebody about it yesterday, actually, when we're down in London, and they were saying they're actually working for a brokerage firm, and they're saying that a lot of their retail traders are losing money at the moment, basically, because they're finding it extremely hard to hold on to any gains or losses. Gains, I should say. They find it quite easy to have losses. Basically because the stops are so tight, and we're getting these very large intraday fluctuations, but then a lot of the time the actual net result at the end of the day is a little net change, and it's just stop hunts, people, banks, big orders going through the market, and not a lot to hold it back. So when we're getting these orders that are pushing through, that euro dollar's rallying 50 points, taking out stops, not really stopping at relevant levels, and then coming all the way back. And I think we've seen that this morning, to be perfectly honest. So, like I said, these are vanilla charts, or what I call vanilla charts. So I'm going to give you guys an insight into basically what I do every day. This is Aspen Graphics. Okay, so these are my trigger charts, if you like. And from here, I break down through time frames, through different currency pairs. And I've got loads of bespoke settings on these charts, literally from monthly charts down to weeklies. This is 4 hour, down to hourly. And from then I can basically tell where support and resistance is going to be. I then use shorter term indicators to trigger my trade ideas. Okay, so it's not just the vanilla charts that I look at, i.e. these are actually Saxo charts. I do have bespoke, or we have a bespoke grey box system that we overlay over the top. But like I said, it's always good when you're looking at a big picture. If you're looking at monthly charts, weekly charts, daily charts, which we're looking at today, sometimes it's quite good to have it just plain, nothing else on it. You can see price action, you can see where markets are stalling, you can see support and resistance, and then we can use our bespoke indicators to trigger our trade calls, basically. And they work, and that's why we consistently use them across virtually all product groups as well, not just FX. So, sorry, dollar index. I'm going to show you this first, because this is the monthly chart. I think this is very relevant. Again, I would never expect somebody to trade off a monthly chart, but it gives us a bias. So what we want, or what most traders are looking for, technical analysts specifically, is you're looking for a bias, and we look to larger time frames to break down where current price action is, and also to give us a clue or an indication of whether or not we're trading with trend, we're counter trending, whether or not there is no trend, and we're ranging, etc., etc., etc. So this is a monthly chart. You can see that we're in a consolidating triangle formation. So this is obviously the high. This is the low of the trend. You'll also notice that the Ishimoku cloud, which I like to use in larger time frames, not down into intraday charts. I only ever use it weekly and daily and monthly. But you will notice here that the cloud has gone thin and it's crossing over all the time, and that's basically highlighting that there's consolidation. Okay, we used to do some webinars on Ishimoku cloud, which you'll probably be able to find in the archives at FX Street. There's so much more to Ishimoku than just the cloud. Okay, we've got the Zen lines, we've got the lagging line, but in its rawest form, the depth of the cloud and where the cloud is located is very important. So this is the midpoint, 80.26. Okay, and we're basically fluctuating. We had dips bought at the cloud, very close to the midpoint. This was last month when we did a report for the Forex Journal about the fact that we expected to see decent dollar buying in. That did come to fruition, but we have had this pullback. So you can see here that basically the monthly bias, there isn't one. Okay, and that when we get to the FX majors will also be reflected, because we'll notice that we're in large channels. There is still a bias. There's always a bias, but it's not as strong as it was before. Okay, so again, that's the monthly chart. Weekly chart, again, doesn't really show us a great deal. We had, my bias is still for higher levels, by the way, in the dollar index, so that obviously that reflects the lower levels. What is the rule principle of the cloud? You've got to remember, everything that we use as technical analysis is, well, most technical analysts use candlestick formations, okay, as opposed to bar charts or line charts. The candlestick formations were made by Japanese traders, well, actually back in the rice markets a long time ago. So the argument that I always have for people when they say, you know, why do you use Ishimoku charts, is because they're predominantly used by Japanese traders in Japanese banks. I used to broker dollar yen a long time ago, back when I worked back down in London, and the yen traders wouldn't look to Ishimoku anything shorter really than a daily formation, okay, because it gets too choppy, it gives away false signals. But the principle is obviously if you're underneath the cloud and you've got deep cloud cover, in other words, the cloud is deep, and you know there's a lot of resistance to the upside. Okay, once the cloud turns thin, there is very little support and resistance because it can quite easily be broken. Okay, so that's the first principle. The second principle is that if you approach the cloud from the downside, then the outside of the cloud should offer as resistance. Also, when you break inside the cloud, I mean, I'm going to rattle these out because there are a lot of rules and regulations to it. When you're inside the cloud, the bias is still to the downside unless it clearly breaks the cloud to the upside. While inside the cloud, the other cloud or outside of the cloud then becomes resistance. So you've got resistance here, you've got resistance here. It only becomes support like other trend lines, like breakouts. It only then becomes support when it's broken out. So what was resistance then becomes support. We always talk about support becoming resistance, resistance becoming support. Okay, so it's only when it's broken out to the top side. But, and there's always a but with technical analysis, when you get a breakout, then the Zen lines have to be in order. And the Zen lines are these lines here. Okay, very similar to moving averages. There's a 9 and a 26. So it's very similar to a 9-day moving average and a 26-day moving average. As a but as you'll see, you get flats. So with a moving average, you'll normally get a smooth line that follows the market. You don't with Ishimoku clouds. You get what these are called flats. And the reason why you get flats is because there's then periods of consolidation. Okay, so that is the 26 moving average, if you like. But it takes the average of the high and the low of the last 26 bars. So if the high and the low of the last 26 bars stays the same, then this moving average will go flat. And it's a very good visual indicator, because then it shows us that that market is consolidating, that there is no trend. Because as opposed to a moving average which will keep on moving with price action, the Zen lines won't. They will go flat. And if you get two Zen lines that are both flat, then you can near as damn it establish that you're in a no trending market. And if you're in a no trending market, then you should be looking to just trade, the channel, support and resistance, etc., etc. There is one more rule with regards to Ishimoku cloud, and that's the lagging line. Okay, the lagging line is 26 periods before price action. It's actually here at the moment, this green line here. So on a breakout, the lagging line needs to be above price action 26 months before in this case. Otherwise, it's a false breakout. So there's three rules that apply to a breakout. The Zen lines have to be in order. It has to be a clear breakout without a retest, and the lagging line has to be above the market or below the market, depending if you're breaking lower or higher, 26 periods before. And that is the basic principle. But just as a visual tool, just look at cloud. But I would also say when you get a breakout, just have a look. It's quite important where that Zen line is and where the lagging line is, to see whether or not it's going to get any follow through. Because a lot of the time people go, well, it broke like here. Well, it broke to the upside. How come it didn't keep on going? And the Zen lines might not have been in order. I can see here that this lagging line, because you've got to take it back 26 periods, the lagging line was here. So it was below price action 26 periods before. So it's a false breakout. Okay, and the market moves back in. But we're not doing a webinar on that today. I'll try and overextend it if I'm allowed to, but we'll get onto the majors. So what I'm trying to say here is the Zen lines have gone flat. Lagging line is in the cloud. There is no trend in the dollar index at the moment. We can break it down through time frames weekly, and this is why I'm giving it a small bullish bias. We've had a decent move up, choppy price action, waves are overlaid. We didn't really stop around 161.8%, but we did stop at 261.8%. Okay, and then we've had this choppy price action weekly. And this was what I was saying about you really got to try as much as you can, I think, at the moment, in not ignoring intraday price action, but trying to go with the longer term frame price action. Because you've got to remember, the majority of the market at the moment, especially the London market, are on holiday. And that's when we get this low liquidity. When there used to be a broker down, pre-money money, August was always a very, very hard month to work, because you get very sharp fluctuations in both directions when big orders came into the market. So if you can try and have or concentrate more on the longer term bias at the moment, then I think it will do you a favour. Now, two of my favourite chart formations, yes, I like dojis. I prefer a morning star or an evening star formation. Yes, you're probably right, actually, Sharon, and that's probably because with the New York market coming in, there is more liquidity, because you've got that crossover where the UK is still working in the afternoon, and then obviously you get the US banks liquidity in the morning as well. So if you look here, we've got a bullish outside bar in the dollar index. Now, a bullish outside bar is slightly different than a bullish engulfing formation, as it actually takes out the whole range. of the previous candle. So the bias was still to the downside when it opened up, okay, but it got completely reversed, it moved to the upside. You then get one to the downside, okay. So you can see how these weekly bars have dominated price action, okay. The only other sort of bar that I also like to see, or a possible bar that you see at areas of indecision, okay. So possible reversals are inside bars. So you've got outside bars and inside bars, and inside bars are called aramis, okay, and you get one here. So they're very good at dictating indecision and trend reversal. And obviously indecision, it can go in either direction. So these weekly bars have been dominating price action. Now, me personally, I think that there's a channel in here. So I take the top here, okay, the bottom here, with last week's low, and I think that we're gonna push back up, okay. I've got to be wary of this candle. So even though my bias is mildly bullish for dollar buying, I haven't really got a reversal candle yet. And even going down into the daily, okay, this level was support. You can see here, it was resistance, it broke resistance and then becomes support, okay, support, breaks, bum, then becomes support. So, as we were saying before, what was support becomes resistance, what was resistance becomes support. We've got slight buying off this support, but it's not aggressive, okay, and that is making the intraday analysis hard to assess, to establish, to analyse at the moment. So breaking that down, that dollar index down into our currency pairs, this is basically what I still see. I mean, we've been talking about this for quite some time, and obviously opposite to what the dollar index did. Obviously, euro dollar is virtually like a mirror, reflecting that back at us, okay, because obviously the majority of trading, as we all know, is done in euro dollar, and it reflects, the dollar index always reflects pretty well back to euro dollar. So here, last week we've had some indecision, okay. I mean, our trade call this week was we have been buying into it up towards the right hand shoulder, what we still think is a channel formation, and basically our call this week has been to trade that range. If it breaks above the high, which is 133.44, then we're going to look for slightly more dollar buying, but not aggressively, probably towards 78.6%, which is here. Which is up around here, around about 135, the figure. If it breaks the low, then I'm targeting the channel base again, which is coming in around about 129 now, or 128.50, and then we're going to look for lower levels in a breakout in a head and shoulders formation. So you can see that, you know, I'd love to be able to turn around, so we've got to see now and it's going to come all the way down to here, but we can't have conviction at the moment. Look like dollar set up for high. Yeah, I think the dollar index is going to go higher, but like Tim, you can't have, or we can't have, that sort of conviction until. There's one thing about it. If I was to say that, then I'd, to be perfectly honest, at the moment I'll be guessing, and we just don't do that. We trade on sound technical analysis. We prefer to wait for a breakout to happen before we trigger trades. So the bias is to the downside, but you know, shorter time frames, this is pretty messy. It's consolidated around 78.6%. You know, we're talking about a break. If we break to 133.44, then there's an ABCD formation that's coming in just above the previous high at 134.36. So upside, this looks pretty weak now. Again, you know, even breaking down into shorter time frames, there are no reversal patterns in here yet. 2 hour charts, like I said, these are just vanilla, but you know, if you put moving averages on here, they're virtually flat. If you put momentum indicators on here, they're virtually flat. So what's the point in trying to guess? I mean, we know that 133 is a barrier. Gets up there, look at shorter time frames to see if we can get any sell signals, any outside bars. Either that, or we're really going to need to see a break through that trend, okay, to push this currency pair lower. But at the moment, as far as price action is concerned, you know, this is still dominating this outside bar that was posted on the 2nd, and it's not been, you know, the Marabouza level was here. It's held that quite well. We've got higher highs and lows still coming in. So it's weak, and we really need to see a breakout of trend. I know that we like to come on here and give more definitive views on where the markets are going, but if there isn't one, then there's not a lot we can do about it, unfortunately. Cable. Again, cable. This is the weekly chart. We've got an engulfing candle in between 50 and 61.8% of this sell-off in the first quarter. We then had a recovery higher. Really need to be breaking it down into shorter time frames. That's not the chart I wanted, sorry. So you can see we're just stalling here, by the way, just at the cloud. And for Sharon, we'll have a look to see whether or not it'll be positive breakout if she goes. Thin cloud cover, okay. Indecision. This was a previous area of support and resistance. Okay. Now the Zen lines, this is the closest Zen line, so it's above the 26, if you like. So the 9's above the 26, so that it's in order, and the lagging line is here. Okay, 26 periods before. So the lagging line is above price action. Okay, Zen lines are going to be in order. So if it does push up, then it's going to be a decent breakout. One thing that you should note as well, if it pushes up and breaks up, then a lot of the time it will come back to test the cloud. If it moves inside the cloud, look to this lagging line. And when this lagging line comes and dips back onto the cloud 26 periods before, that sometimes holds support. So that would be around 153. So if it breaks out and then comes back, don't assume that it's going to come all the way back. Look to 153 ish, 153.10. I think it probably comes in at as the support. With regards to a bias, there's very little bias today. Price action's been poor. I think we get a break to the upside. If we get any reversals this week, and we've got to remember we've got Carney tomorrow, then buying around 152 is decent for risk reward. You probably put a 50 pip stop in. So we've got a Marabouza level coming at 151.98. Our bespoke support, our grey box system, if you like, comes in at 152.20. So we've got support 152.20, 151.98. We'll probably be able to put a stop in around 151.50, not below the low, because if it gets that far down, then there's a very good chance we're going to be wrong. We want your risk reward to be half decent. Then a move up, a break of the cloud top, which we're basically hovering around at the moment, and you've got an ABCD formation coming in at 157.20. Now, you might be saying to yourself, well, if I'm predicting the dollar to go up, how can I also be predicting sterling dollar to go up? And again, we have to look back at correlation, because using correlation, euro sterling is very weak, okay, and should push through aggressively, I think, in the next couple of weeks. In fact, it was one of not trades of the week, but it was one of our favourite trades this week was to get short of euro sterling and build on a short position. So that's the one that we'll look to next. Any questions about dollar index, euro dollar cable before we move off? And it's all about price action. Okay, when I say it's all about price action, it's all about price action, but at points of support and resistance. Okay, I don't trade off daily charts. I very rarely trade off hourly charts. I do trade off 15 minutes, 10 minutes, 5 minutes, in 3 minutes, and even 1 minute charts to get very, very tight entry and exit levels. If I'm trading off a 1 minute chart, I can do it in probably 10 times the size that I can do it if I'm trading off a 15 minute chart. Okay, because I know my top stop's going to be that much tighter. If I traded off a daily chart, then it would be the 50th of the size that I'd trade off a 1 minute chart probably. So it is all about having a bias. It's about having a knowledge of where support and resistance is going to be. And it's not about just pulling the trigger because you see a doji on a 5 minute chart. Yes, you can pull the trigger if you see a doji on the 5 minute chart at an area where you expect support and resistance to be, because that's a confirmation that support and resistance is holding, but not just because you see one. And I think that's very important point to put across, is that, you know, we all talk about price action or analysts talk about price action, but it has to be at relevant levels. If it's not at relevant levels, then it's not relevant price action. You know, here, bullish outside day, it's that 50% pullback of this last move. So it's a relevant level. You know, if you looked at a bullish outside bar here, well, it's not the start of the trend, it's near the end of the trend, or it was the end of the trend. So again, it becomes less relevant. Marabuzo levels are very important. A Marabuzo level is 50% of the open and close of a strong candle formation, and the market will have a tendency to move to a Marabuzo level and then reject. So again, going back to price action, if you see a bullish outside bar in 10 minutes at a 1 AM Marabuzo level, you know you can have a very tight stop. You know that price action has been to the upside, and it's probably just a correction down to the 50% level. And that's a decent risk-reward trade, and that's what we're looking for. We're constantly looking for just decent risk-reward trades, either intraday or long-term. Dollar Swiss. Now, so dollar Swiss a lot of the time, majority of the time, Euro Swiss doesn't have a tendency to go far. Okay, a decent range in Euro Swiss is probably 40 ticks a day. Average range in Euro Swiss is probably 20-25 ticks a day. Okay, so the majority of the time, what happens in Euro dollar will be -1 reflected like a mirror reflection in dollar Swiss, because obviously in one you're buying dollar, the other one you're selling dollar. Okay, and Euro Swiss has a tendency to go nowhere. So just overlaying those charts on top of each other, you should virtually have a -1 correlation. So here, dollar Swiss, sorry, been grinding lower. Intraday analysis, obviously, inside a wedge formation is extremely hard to dictate, to forecast, etc. What we have got is we've got a breakout, and then we're going to retest in the breakout. We're looking for higher levels. 95 is prime, okay, or just under 95. Wedge breakouts, and the target is the start of the wedge, which is actually coming in at 95.32. However, we've got a 161.8% projection level just underneath that, 94.92. So that would be my first target area. I think buying here offers extremely good risk reward. You know, you're looking at what, 250 points, 225 points to the upside. Stop of really a close inside here, which is 92.20. 92.20 was the low. So you got a 50 pip stop, about nearly 5 to 1 trade call there. You really need to see a break above 93 to confirm. But, you know, break it down to shorter time frames. Sorry. We can see that dips are being bought. This trend is holding well. Like I said, you really need to see a break of 93 just to confirm higher highs and higher lows. But like I say, great risk reward trade. This whole move looks corrective, and with the dollar bias reflected from euro dollar, I think we move higher. Okay. So the yen. We bought this morning. We scraped in the first target, and then it's pushed lower. This, to me, just looks like a flag formation. If we break it down into shorter time frames, 8 hours. You can see that was virtually a perfect ABCD formation. ABCD formations, so AB, so you take the leg, you then mirror it for CD, okay, are corrective patterns. So just stop short of the ABCD formation. It's in a channel. You really need to see a breakout of 100, confirm medium-term biases to the upside. A break of the low and minimum downside. Well, I should say, there weren't great non-farm payroll figures on Friday. We only trade technicals, not fundamentals. We did get an outside bar, we've drifted lower. But it wasn't an aggressive sell-off. I mean, jobs added was worse than expected, but the unemployment rate's actually come down. And with everybody actually looking at tapering at the moment, you know, they've just said that if they get down to 6.5% unemployment, then obviously, I think aggressive tapering would probably start then. Then I could quite easily see this pair going a lot higher. Like I said, at the moment it's in a channel. I'd look to buy dips anywhere from here down to 97 on short time frame. Confirmations, or a break of 100 basically. Break of 100, you can look up to 103.50. Again, pretty tight stop, probably a 50 pip stop, and about 7 to 1 risk reward. So I think, yes, I think it will retest 100. Probably not today. What you should also always note about corrective patterns, okay, is the fact that they're in 3 waves, okay. So here, down, 1, 2, 3. This one's 3 waves, okay. You can't see this pattern. Well, I can't see this pattern in 3 waves. So there is scope for maybe a move up to 99, where we've now got resistance, and then a move back down towards here to form another 3 waves, okay. Just because we've got an ABCD here doesn't mean that it's completed, because it's not broken the sequence. We haven't got higher highs and higher lows on the daily chart. So there's scope for some more selling. But I think the immediate bias, intraday bias, is for higher levels. But again, only towards 99. Not a lot you can say about it at the moment. It's stuck in a channel. Dollar CAD is a bit more interesting. I like dollar CAD at the moment. Expanding wedge formation has an eventual bias to break to the downside. Eventual. It's got months of scope to keep moving higher on the daily chart. If we break it down to weekly, that's not what I wanted. Which I think is far more interesting. Okay. This actually, that's a weekly chart. Is it a weekly? Got quarters on here. Is it monthly? That's weekly. Sorry. Okay, large shadow formation. We broke to the upside. Then we've come down and we've retested. Now, medium term, I think we move up to here, okay, which is 108.80-ish. 108.82 is actually a perfect ABCD formation. It's choppy, okay, but what we have got, what we did get last week, is we got buying off the reverse channel top. So it was resistance, okay, it's broken, it then becomes support. We get an outside weekly at support. Buying dips has basically been our call. We actually bought from the open this morning just on the back of yesterday's small sell-off. So again, these are decent risk-reward trades on longer term forecasts. Would you be buying halfway back into the most recent bullish engulfing of dollar CAD? Yes, but I don't think you get there. Dollar CAD's quite hard because commodity pairs will have a tendency to run through fibs. So it won't stop at 261.8%. And it'll have a tendency to run up to 423.6% or somewhere in between. And because they're so good, these moves are so aggressive, indeed, as commodities do, because the moves are so aggressive, also the retracements are sometimes very, very mild. I would always prefer in commodity pairs, and the reason why they run through is because people say it's because smart money is in commodities, because commodities are the real driver, and that's why they move quicker, faster, and first. A lot of the time, when you're looking for a change in dollar bias, you'll see Aussie dollar or dollar CAD turn around before the other currency pairs also flip over. So what I prefer to do in dollar CAD, Aussie dollar, get a decent formation, is to actually get in, but just don't get in your full size. So if your full size is 4 units, 4 lots, whatever it might be, £4, €4, I'd have a tendency to buy 2. If it comes back down towards or to the Marabuzo level, then buy another 2, and obviously have a stop that reflects that average price, as opposed to missing it basically. So yeah, again, a decent risk reward trade. Just buying here, you can have a stop below, but it's still a decent sized stop. It's still 140 odd ticks from current levels, and that's quite big in dollar CAD. So what I have a tendency to do is to try and buy into dips, but I don't think you're going to get any aggressive dips. Use a simple moving average. That's one easy way of buying into dips. You put say a 20 moving average on a chart, and then when as the price moves back to it, you use that as your trigger, and then just have a set stop of a percentage away underneath that moving average. And then you just keep buying the dips, buy the dips until you've got your full amount on, and then whatever your average is, obviously trail up with a stop. Getting off the subject again. So I'm a bull. So I've got dollar buying here. So reflecting all these things back, the only one that's sort of disjointed with the dollar buying is cable, because we're expecting dollar buying in euro dollar, expecting that to go lower. Dollar Swiss we're expecting to go higher. Dollar yen we're expecting to go higher. Dollar CAD we're expecting to go higher. Aussie dollar we're expecting to go lower. So again, quite decent cross currency plays. They're going to be Euro Sterling, Sterling CAD, Sterling Aussie, etc., etc., etc. I have a tendency to only really trade majors in my own pocket, because I don't like trading massive spreads basically. Aussie dollar monthly. This is one view. I've got a few. Like I said, I've got lots of views in Aussie dollar. I've just got a few views. This, I think, is a potential target. Down towards 84.08. We've had a bit of upside pressure today, but that would then form a bullish back formation. So 84.08 is something that I'm looking at in the medium term. Shorter term, and we're going to get a bounce, a mild bounce. Okay, so this is another way of looking at the same chart. Okay, so an ABCD has been completed at 88.48. Okay, it's a channel base. It's an ABCD formation. But notice that it pushed through 261.8%. So again, it's a commodity pair. I think rallies just get sold into. I'm going to say 8 hours. That's what we're going to talk about. Okay, we've got trend line here. Dips have been bought underneath it. 261.8% close by. Bit of a push back up, but looking at weekly, you know, we talk about price action. It always does that. You have to open them all back up again. You know, that was very strong down week. Okay, in Aussie dollar, we bounced off the channel. You've got Marabouzo here, but I don't think we get anywhere near that. We're actually looking at selling, or we've got some RB spoke resistance coming into that 90.35. So again, flexing it back to 8 hours. $90.35 we're looking to sell. It depends what your risk reward profile is really like on this. And again, I wouldn't look at putting in full size at 90.35. The support here. So you've got to be careful with where you know you're wrong, okay? And you know you're going to be wrong on about 100 ticks stop, but it's obviously very expensive. And that's what I'm saying. But so is the reward. The reward is also fantastic because we're looking at 400 points for reward against a 100-point risk. So trading in smaller size, we can still achieve that goal, that 4-to-1 goal. I wouldn't recommend anybody putting on full size at current price because I think there's still scope for a dip and then a move back up, maybe towards 90.70 tomorrow, but then for that bias, off the weekly bias, okay, off that back bias, off the monthly chart, eventual break through that channel formation, and then a continued move to the downside, and that again reflects back to dollar buying. Okay, so out of the $6 based pairs that we've been looking at on FX majors, you've got 5 that are basically pointing to dollar buying as far as I'm concerned. And then we get to Euro Sterling. This is a daily chart. And monthly, this is quite a long time ago. I mean, it's been in a large channel formation for some time. Okay, it has spiked through, and then it broke and closed above last month, basically. Question's been answered. I'm still not sure about this rally. Basically on the basis that the formation, even though it got to 61.8% of this last move up, and it has moved higher, it just, shorter time frame analysis does not look strong. I think long term we still go up, but in the medium term, I look to this sort of level, this 83.10 level. So, okay, we've got Marabuzzo. It's a previous area of support and resistance. And this hasn't broken out and aggressively moved higher, thank God, because I'm going to Europe on Saturday. So 83.10, I think we pushed down towards that. Breaking that down to shorter time frames. That's what I want. Okay, this is the weekly. We had a gap close, so there was a gap open here going back to February, March. Okay, that push up closed the gap, and we had lots of spikes higher, which basically showing that the market's really sort of is lacking conviction. Okay, as rallies are going up, obviously investors are taking that as an opportunity to sell into gains. Okay, so we're selling into gains. We've got this decent area of resistance, 87 the figure, and we can see that it's held numerous times with spikes higher, and that's what happened last week. Okay, and we've pushed down. Now there was an intraday 161.8% extension level at 86.22 this morning, which was virtually bit perfect. So we've hit that. We've got a small recovery higher. I think we can probably show that. Again, the move higher was pretty aggressive, but the move down has been quite aggressive as well, which is obviously what we want to see with regards to trading with trends as opposed to trading against. Come here. Okay, so 86.22, so we spiked through, moved higher. A classic fourth wave correction as far as I'm concerned. Again, need to then break down to shorter time frames. Let's have a look at some reversals. This is a decent area, 86.52. I break it down into even shorter time frames and just look for a mild three wave correction, maybe even an ABCD formation. But 86, I wouldn't expect to get much higher than 86.60. The reason I'm saying this is because, again, it offers great risk reward when we break it down to, or back down to this weekly chart. If we can get in on the fourth wave correction, the support here, okay, 86, the figure. That's my tracker for. Going back to here, okay, I can see a breakout this time because 261.8% is not until 85.30. So going back to weekly, and this is what we're talking about, time frame breakdowns. Okay, spike higher, the move lower. Okay, we have got some support at 86 the figure. A move mildly up from 86.22. Then we said that that's 261.8% projection is at 85.30. Okay, if we use the track bar or crossovers here, okay, if we look to where the channel base comes in, I actually did it bit perfect. It's 85.24-ish if it does it this week. Okay, so anywhere between 85.40 and 85.24. So the 261.8% projection, okay, no problem, is lined up with the channel base. So out of every currency pair that we're covering at the moment, this offers probably the best risk reward. I know people don't really like trading euro sterling because they say, well, it don't move that quick because of the pips. Do bigger size. You can have smaller stops and larger targets. So I'm expecting to move down to 85.30, then 261.8%, a push back up to 86, okay, which was support, going to break, then become resistance again, and then a decent leg down to where we were talking about in the monthly chart. You guessed it, the Maribuza, which is 83.10-ish. On here, it's actually 83.52, so anywhere between 83.52 and 83.10. Any questions, guys, before we wrap it up? We've just been told that our time is up. Any questions at all? So basically, breaking it down into how I or we, Steve and myself, analyse the markets. It's predominantly price action. We then have a grey box system, which I said before, which is overlaid on the top, which basically shows us where support and resistance levels are. And then we're trying to sell recoveries or buy dips, trading with the trend majority of the time, unless risk reward warrants a counter trend move. Okay. No questions? No? Okay, guys. Well, I hope you enjoyed it. I hope you found it informative. Sometimes I digress a fair bit. I apologise. Well, I don't apologise, actually. Like I said, we have done a webinar before on Ishimoku Cloud, so if you want to look more into that, have a look through the archives. Okay, thanks very much. Enjoy yourselves. I'm now away for 2.5 weeks, but I'll speak to you all when I get back. Okay, thanks very much. Bye.